friends, thanks for joining us for this month's update on our livestock markets. I'm Coulter Brown from the Northern Ag Network. Gotta be honest, it's a lot more fun to put these reports together when you get to be the bearer of good news for a change. Lower feed costs, stronger calf prices has us wondering just how high this thing can get. Well, we have a ton to cover here today. We'll of course start out with the update on the futures market and the fed cattle, talk about where we're at with cattle supplies and when the industry will enter an expansion phase and what might slow that down. Then we'll dive into the red hot video sale market, talk about some of the recent sheep sales, and wrap up with the long-term market forecast. First though, want to thank the sponsors of our report, Ag Risk Advisors. It's time to start thinking about pasture, rangeland, and forage insurance. There's still plenty of time before the December 1 deadline, but if you want to see some examples on how PRF could work for you and help mitigate drought risk, visit them online at prfadvisors.com. Well, the performance of the cattle market this year has been nothing short of impressive. We look at what the feeder futures have done just since March. We're up 16% on the feeder futures, going up from 217 to now 252. And that's actually off a couple dollars from contract highs that were reached just a few days ago. I had to double check the month-over-month gains. We're up $6 to $8 in the feeders from where we were a month ago. Look out to April, we've got feeders at 260, and that contract is for 8-weight steers, not calves, so you can see there's starting to be some recognition for just how tight these supplies are getting. Now in the live cattle futures, they didn't have as strong a month as the feeders, still moving higher, but the gains were much more modest. Live cattle feeling some seasonal pressure as they typically do this time of year. The late summer and early fall is when the market finds its lows. But as we get into the fourth quarter, we could see prices improve as holiday beef demand picks up and cattle supplies tighten again. We'll look at some of the month-over-month gains there, looking pretty strong, but some of the pressures hitting the live cattle futures also dealt with packers reducing the processing pace. Now, packers were losing $100 a head for a while there, while feed yards were making $400, so packers cut the kill, trying to back up the cattle supply to some degree and decrease the amount of product going out. In this month's Cattle on Feed report, we did see the results of tighter supplies starting to come to fruition. Total on-feed inventory down 2% from a year ago. Placements were the big bullish surprise though, 8% lower from last year, and that was falling more than expected, so definitely good to see. Now last month we talked about the semi-annual cattle inventory report update that's showing beef cow numbers continuing to contract, and that's going to help to support calf prices as we move forward. But the question now is, when is the industry going to expand? We know that the expansion signals are there from a market perspective. It's looking pretty good there, but when we start to retain heifers, we're actually going to see beef production decrease further. Once we start to see bigger calf crops though, the prices will come down. So the question I am asking is, how aggressive is the expansion going to be in this cycle, and how fast are those prices going to come down? You'll remember in the past cycle in 2015, we saw the national average on 5.5 weight steers peak at $250. A year later though, that average plummeted to $1.60. There are some reasons though to suggest that this expansion may not be as aggressive and as fast. Chief among those are drought. It's still an issue in a large part of the country. Now, many of us have seen vastly improved moisture conditions this year, which we're definitely thankful for, but a lot of areas still battling drought. And you know, once drought does end, these pastures need time to recover. We got to rebuild hay supplies. All that takes time. Compared to where we were a year ago, 57% of the cattle herd was battling drought. Now that's down to 37%, so quite a bit of improvement, but still a significant amount of the herd. Past drought recovery, we also need financial recovery. These past 2 years have been the most expensive calf crops we've ever raised, with high input costs and atrociously expensive feed. Some costs have come down, but a lot are still elevated, so the higher prices are needed just to break even, but we're going to do a lot better than that for most operations this year and really start to get these places healed up. I do want to touch on feed costs again though. Corn prices are down over 20% from where they were a year ago at this time, and since peaking in late June, we've actually seen September corn drop $1.60. Now, sometimes I hesitate to talk too much about the hay market just because it can be hyper-localized, can really change production and prices in not that wide of an area. But just as an example, I pulled up the August hay reports from USDA in Montana over the last 5 years, and you can see just how much prices jumped and how much they came down. Now, this may not be representative for every area, but at least some places are seeing those hay prices return back to historical levels. The other big factor as we consider what expansion might look like in the cattle industry in the next phase of this cycle is interest rates. When the herd expanded in the previous cycle, we saw the average prime loan rate at 3.25. Now that's up to 8.25, so substantially higher. That may temper expansion and may decrease producers' desire to take on debt to build the herd. But either way, these calf prices look great. Want to look at the video sales from August here, where we saw some definite strong prices. The fact is, none of us have enough calves to sell this go round. In the Northern Livestock Video and Superior Livestock sales, the big calves had some great demand. Lighter steers, steady with July, maybe a little lower in some cases. Certainly less heifers in the sale, and that discount on heifers did seem to decrease as well. In the sale, we saw the light 5-weight steers ranging mainly $3 to $3.25, upper 5-weights $2.85 to $3.05, 6-weight steers $2.70 to $2.90, and replacement heifers seeing strong demand largely from $2.79 to $2.94. In the sheep market, things are finally looking up. We're seeing lamb slaughter that's down 10% from a year ago, driven partially by just lower lamb numbers this year. Also, product in cold storage is down, imports are down. We've got the lowest lamb on feed inventory since 1993. As we saw in the video here, prices are improving. A lot of those lambs delivering in late September and early October weighing 80 and 90 pounds from 222 to 232. At the public auction yards recently, 70 to 90 pound lambs 223 to 237. And wrapping up here, I want to talk about Cattlefax's long-term price outlook. Yowza, I thought I was bullish on this cattle market, but Cattlefax is saying prices are going to continue to move higher and will set new highs multiple times over the next few years. 5.5-weight steers, they're projecting to average $262 this year, next year up to $315, and in 2025 a cycle high at $350. Fed steers expected to average $1.94 next year, and 8-weight yearlings at $245. So a lot of optimism. We're excited to see just how high this market can go. Thanks for joining us for this month's report. I'm Coulter Brown, Northern Ag Network.